Hello there, Adam Gower here, and welcome to the GowerCrowd Podcast, the real estate crowdfunding show Deal Time, where you can learn about active crowdfunded real estate deals directly from the sponsors themselves. Subscribe to my free weekly newsletter at GowerCrowd.com, where you'll get links to the podcast, as well as news and updates exclusively from the world of real estate crowdfunding. Sign up at GowerCrowd.com so you don't miss out. Also, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and look for links on how to submit your deal. Please note that while I don't endorse the deal, sell securities, or make investment recommendations of any kind, some sponsors are GowerCrowd clients. Now listen in and learn about the next great deal on the GowerCrowd Deal Time podcast. Here we go. Brock Freeman, Chris Carsley. What a pleasure to meet you again at Kirkland. Why don't you start off, if you would, please? Give me your name, company name, and position. Tell everybody who you are, who you work for, and what you do.
My name is Brock Freeman. I'm the COO for Kirkland Capital Group. My job is mostly around loan operations, which is acquiring loans from loan brokers, underwriting them, secondary marketing, training our team on underwriting, along with a lot of marketing duties, and anything that Chris refuses to do, of course, must fall on me.
Chris, who are you? What do you do there at Kirkland?
It's a good question. Brock asks all the time, what do you do here? No, I'm Chris Carsley. I'm the Chief Investment Officer for Kirkland Capital Group. I run the portfolio. I deal with risk management, investor relations, accounting, anything that is in relation to the function and operations of the fund.
All right, so come on, tell me about the fund. What is it that first of all, how much are you raising?
Right now, it's an open raise. I think that the capacity of our entire fund, and if we want to quote the actual legal document, we're looking for a total raise of around 100 million.
And what are you raising money for? What is the fund? What are its parameters?
Well, we make micro balance, which is loans under $1 million on commercial real estate. These are short-term bridge or hard money loans, 1 to 12 months. And it's a unique arena that has been a very tough arena before for other funds. We have some technology background along with just the great fund management background that Chris has, where we feel like we have an advantage here that we can take advantage and be able to run and make some great outsized returns for investors at a lower risk.
So you are a debt fund. You're raising money to lend to borrowers in commercial real estate. What kind of commercial real estate? What are the fund's parameters again? What can you invest in?
Multifamily, office, mixed use, retail. Those are really the main places that we invest in. And some of those are higher risk now, with office and retail, which we do at lower LTV. So we make adjustments in the fund around those in order to make sure that even though it might be a little bit riskier office class in general, we lower the LTV so that our focus on never, ever, ever losing the principal, never, ever losing money, it continues to be the case.
And how are you underwriting deals then? So you're looking at a broad range of asset classes within commercial real estate. What are the parameters for? What are the key, the top 3 or 4 key things that you look at to decide whether or not you're going to look further?
Well, first of all, we don't do any ground up or raw land. So we want an income producing. So even if there's vacancies there or high amount of vacancies, it should be able to be some sort of asset that can be turned around in a 6 to 12 month period where they're now fully able to get to normal long-term financing, usually bank financing, traditional financing, and do a takeout. And if that can't be the case, that exit, then we won't do the loan.
So what kind of deals are these then? So you are at like an interim lender ahead of high street bank lending, essentially. So for some reason, your borrowers are not able to get loans from banks. So what is it? What does a typical deal look like that wouldn't be able to get a bank loan that you can lend to, that once they've paid you off, they would be able to get a bank loan?
Right. We see most of them because of vacancy factors. So the current or the last owner did not maintain it very well, and so they've got high vacancy. And so that means you're going to have a DSCR, debt service ratio, that's going to be below the 120 or 125, 1.25 that banks allow. That's going to be a problem. Number two, maybe you have issues with the asset itself that need renovation. We had one in Texas where there was a foundation issue. Banks are not going to lend on that. Now, it didn't cost much to take care of it, but again, banks are they're just not going to touch it. And sometimes on borrowers, there may be, they got a little bit too low credit score and they need a little bit of run ahead of them to get out there. Or what we see also is because they just don't have, like cash out. We'll do cash out on deals where a bank won't do it. The old joke on banks is we're not going to lend you anything unless you don't need the money.
Right, exactly.
We'll actually lend it when you need the money, and we'll take that asset as collateral. And that really gets them to a place where they need to be in order a few months down the road to be refinanced with long-term financing.
And what are the, because maybe Chris, you could field this. What are the kinds of returns that you look for? How do you underwrite from a financial perspective?
Yeah, from a finance standpoint, I mean, we're always trying to match, what we're being, paid given the risk. And so Brock and I will actually walk through the entire underwriting package with that notion. And most everything that we're writing to is somewhere between 10 and 12%. So there is something that needs to be done to the property, or in some instances, some of the things that we'll see is there's going to be a transition of property. We had one that was a great trade. It took us a while to kind of walk through, but we had great conversations directly with the borrowers, and they were going to reposition a motel into apartments. And that kind of transition there, again, banks are not going to lend to that. And there's a complexity to that where, your mom and pop hard money lenders, they might not lend to that either because they just don't understand what the end of the trade is going to look like. So, but, those types of, people say it's sort of hair on the trade. That allows us to really kind of target and consistently find quality properties where we're charging, 10 to 12% gross.
You mentioned, actually, Brock mentioned loan brokers. So is that how you're typically sourcing deal flow, is through what? Loan brokers who are unable to find a bank to lend, or do you fit into their hard money box? Like, how does that work?
Yeah, I'd say usually they're looking at us as their hard money box. So, I mean, loan brokers, I view them, why not leverage them? They're your sales force in the field. Otherwise, you're going to end up having to build relationships with literally thousands upon thousands of real estate brokers, commercial real estate brokers that may send you a deal one every 2 years. So it's really hard to stay top of mind with them. Whereas loan brokers, they don't have a lot of choices for the type of loans that we do. And so generally when we contact a lot of them, unless they're the type of broker that are like, oh no, I only do 5 million and above, I don't even touch lower stuff. And good for them that they can do that. But we deal with a lot of smaller loan brokers that this is some bread and butter stuff for them. So they're super happy when we contact them and reach out to them that they have us as a choice for their clients.
Interesting. Well, and what geographical area do you look at?
We do nationwide. We don't have a specific set of states or anything. We look even in secondary and tertiary markets. We find some of those actually have better returns than some of the gateway markets. And Chris and I feel comfortable because we both came from smaller cities. So we kind of understand the dynamics and the economics of those.
And you travel to see each deal, do you?
Nope. That was one of the challenges, I think, that other funds and why they move up from this is because if you're doing a $300,000 loan on a deal, you can't afford to go fly out and do boots on the ground. And so we had to come up with, how do we determine whether something is lendable without actually going out there to visit ourselves? So we use a number of different private and public data sources. Each one we order what's called a commercial valuation from a national company. We use Clear Capital and to get those in. So we drive some consistency with understanding the value of those, and they go, so we have third-party reports that go in and look at those. So that's how we approach those. We don't go actually visit them ourselves. We wouldn't be able to scale if we did that.
Yeah, and one thing that's interesting is the technology of today's world, though. You can do walkthroughs, live walkthroughs. You can do a number of different things as people are going through those properties and really obtain a great deal of information, from people. So that's one of the things that we've developed and will continue to develop and enhance,
It's incredible technology today. You
Yeah.
can walk through a place as though you were actually in it. This really is extraordinary. All right. So talking about being in it, what's in it for investors? Come on, that's the meat and potatoes of what we're talking about. What's the minimum investment? How do they get paid? How does it work?
Minimum investment, there again, according to the doc, is 100,000. We have been doing a lot of different specialized deals down to 50,000 for people. I think a lot of high net worth that was a little bit more palatable to put their toe in the water, get a feel for.
Mm-hmm.
And being an investor in a lot of alternatives, I've done that myself. Let me give you a little bit of money, and then let me watch you for a while, build a relationship. That's definitely occurred. I laugh because the first 6 months of some of our investors coming in, they all wanted to talk to me every single month. And now I don't try to take it too personally. None of them want to talk to me anymore. They keep on adding money to the fund. So we're doing things right from the fund standpoint. They just don't want to talk to me. And then our fee structure is very, very simple. This is one of the aspects of one thing I enjoyed about building this fund was we have a 1.5% management fee. That's it. We don't have any other layers of fees. There's obviously fund expenses, but I have no problem divulging. I think last month's fund expenses were $545 for the entire fund. So basis points. So really that 1.5% management fee makes it very easy and very transparent for investors to say, listen, if my portfolio has a gross yield of 11.5% and you're going to be paying 1.5%, well, then somewhere around there, assuming that, we have 100% utilization of cash, which doesn't always occur because these are chunky trades, you're going to be somewhere around 10% net. And that's really what investors are getting. The other aspect, that's the return side. I always think about risk. Brock and I built this and have the same mentality of risk first and then target return. We want to be lower on the risk curve. We want to be in the properties, as we stated, we don't do piles of dirt. We do income producing properties that have a clear window that we can understand where they're going to make it to an exit so that they can pay us the interest and then they can go get conventional loans and then we can recycle money into another loan. That is what we want to search for. We want to be lower on that risk curve and so that we can offer a consistent, very high risk-adjusted return in a market right now that from a traditional investment standpoint, you just can't get high single or, low double-digit returns. It's just not available. So, hopefully investors are looking at this and it's palatable to them to look at alternative investments as a fixed income alternative. I know we're in real estate and we use real estate to control risk because we're first lien, full recourse on all our loans, but we really kind of view ourselves as a fixed income alternative.
All right. So somebody invests in the fund and you've said a couple things that didn't quite resonate. So let me ask you this.
Sure.
Presumably the fund is its own portfolio, but you mentioned that you suggested that individual investors might have unique portfolios that somehow they're able. Explain exactly how it was. It's a straight investment in the fund, right?
It's a straight investment in the fund. The fund runs its own pool of investments and everybody participates on that on a pro rata basis. And that's actually rebalanced every single month so that everyone in the fund is really obtaining the most possible diversification across all assets in the portfolio.
Rebalanced. What does that mean exactly?
As money and deals come in, what you're doing is seeing how most of the loans that we write are all very similar rates. Let's say if the entire portfolio is right at 12%, that's the gross yield of the portfolio. I bring in new money and I bring in a deal that's 12%. What I want to make sure is that new investor actually has a pro rata allocation to loans that may have been in the portfolio before they even were involved in the fund. So that every single one
every single investor is sharing across the portfolio on a pro rata basis.
In
So I'm
equal
spreading exactly spreading that risk as best as I can for every investor in the fund, because there's always, well, the number one risk in this entire trade is, well, it goes from a default to a foreclosure. And I don't want, oh, hey, all your money went into the one that went default. I don't want to have that conversation with an investor.
Right.
That's
fund wise.
Yeah, it's fund.
Now you guys also have a fairly, so you got $100 million nominal raise. This is an open-ended, so you're going to continue cycling capital as it comes and goes, right? These are short-term loans. What's your guys' co-invest alignment of interest? Tell me about that.
Well, our document actually states that at a minimum, the partners have to have at least 500,000 in the fund at all times. We're more than that right now, which was nice. That's actually been verified by a few investors and a few platforms. So it's nice to see people reading the documents, which is, I'm always yelling at everyone, please read your documents. We all know that people don't do it, but they should. So yeah, we'll continue to build that. I mean, I'll be honest with you, for me, I have a lot of secondary venture investments. I have a lot of private investments, hedge fund investments. I have some traditional portfolios personally. For me, I was lacking real estate exposure. So this is personally a huge boon for me, where a lot of additional capital for me personally is going into this fund. And, that's where I'll continue to allocate because I just can't find a risk-adjusted exposure like that, especially in the traditional markets. So where, I mean, we can pay money out monthly if it's something you need an income component. But for most of our investors, like myself, I'm just letting that interest collect. I'm compounding that every single month. And I don't know about you, but run your compounding, 10%, compounded over a number of years gets to be a very large number.
So somebody investing in the fund, is there an early exit possible?
We will always perform best efforts. I've done that with every fund that I've ever worked for or built. And what that really means is we have a year hold period because we want to try and match assets and liabilities as much as possible. We do up to 12-month paper. And a lot of the properties we're seeing right now are value add based. So they tend to be closer to that 9 to 12. So we want a year hold. So we have time to deploy money and we don't get pinched where you're like, hey, turns out it's not for me. Or you just maybe have a personal event in your life and you need liquidity. Great. I want to be able to get that back to you. The other aspect of our liquidity is we ask for 60-day notice. So let me know in January if you need money, in March. Now, with that said, we will always have things rolling off. And if there's a true emergency, I'm going to be living, under a tree if I don't get this money out. Well, great. That's where that best efforts comes in. And, it's obviously on an individual basis and it's manager decision. But I'll try to deploy that for everybody we can. So
let me ask you, in the interest of time, unfortunately, because we are so tight today, I'm going to ask you my last question. My last question is like this. I always like to frame it this way. So it's impossible otherwise to figure it out. But if you imagine this was radio and playing live, not something you can choose to actually listen to all the way through, and your ideal investor, the perfect investor, tunes in now, right at the end, what would you like them to take away from this broadcast in a couple of sentences? What would be the most important thing you want them to hear? You can both have a crack at that. See, as you think about it.
For me, I think I want investors to walk away with this understanding that we're risk first. We are all about capital preservation. That is very, very important to us in the way we do our underwriting. It's the way that we structured our fund. So much to the point that when we were 2.5 million assets under management, we had such process and procedure in place at the fund level. We were brought on to major investor platforms, AI platforms. So, I mean, we've been sort of given that stamp of approval of process and procedure around protection of investors' capital. So not only at the investment level, but at the operational level. That's what I want people to understand what we've built here.
Brock?
There's a lot of tech workers. We're in Seattle, so we meet a lot of them, but I think there's other places as well who have reached that accredited status, investor status, because mostly their income, reaching $200,000 a year for the past 2 years. One of the best things they can do that will make a huge difference between them and others is to then start exploring alternative investments. There's a lot of fun stuff out there in the alternatives world, but perhaps the first time you dip your toe should be something that's a little bit less risky. And okay, I'm biased a little bit, but I think what we offer in the real estate arena or with fixed income is a good place to dip your toe, where there's not a lot of moving parts. You make your first alternative investment with us. You get comfortable with how that works, reading your docs, doing that sort of thing. And then 6 months to a year out, you think, hey, I like this stuff. I'm going to expand. I'm going to do maybe a multifamily deal. I'm going to do crypto. I'm going to do some VC investing, something else. You're sort of getting that entryway into the world of alternative investments with something that's very low risk.
Brock Freeman, COO and managing partner. Chris Carsley, CIO and managing partner. Thank you of Kirkland Capital Group. Thank you so much for joining me today on the Deal Time podcast.
Thank you very much.
Thanks a lot, Adam.
If you want more information on this deal and on all the others in this new series, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together for you, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It's totally free, and it is the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet, all there at GowerCrowd.com. Thank you for joining me and for listening in to today's deal. This is Adam Gower wishing you well and signing off.